We're live on Zoom too.
Okay, great. So welcome, folks, to our mid-year financial health check. We're looking forward to sharing some useful information that will help you to have a great second half of the year and accomplish your goals for 2024. Get ready for 2025. And we're going to give people a few more minutes to gather. Usually we have about a five-minute window before we start. We'll give people a chance to get logged on, get settled in. If you don't have a cup of coffee, go get one. Get your notes ready, and we'll get started shortly. I'm going to have my cup of coffee. Well, I hope everybody is doing well in the weather today. I'm located about 45 minutes north of New York City. And this morning when I was out walking the dogs, I have to say I was really glad I was going to be going back inside to the air conditioning. I saw some people out doing work outside, and I feel really bad for them. I hope that they're able to drink lots of water and get in some shade. And for those of you that have crews out and about, I hope that you're able to keep all of them safe. Um, we have a heat advisory here of just over 100. And the dogs that I was out walking are two big hairy collies. So they were just as happy to come inside as I was. It looks like we're going to get a break in the weather today or tomorrow. So that'll be good. It'll drop down about 10 degrees and that'll be much more comfortable. But I have to say, it is nice to be in summertime. I like the summer better than the winter time. And even if it's really hot out, I enjoy being warm. So for those of you who are here already, my name is Andi Gray, and I want to welcome you to our webinar. Dahlia Jennings is on with me as well, and she is going to be running the slides and also handling all of the Q&A. If you have any questions as we go along, please shoot your questions to Dahlia in the chat window. You can send it to her privately, or you can share it with everyone. We will be taking questions as we go through the webinar. We'll probably take most of them at the end. If you have something really urgent, raise your hand and Dahlia will pay attention and get your question in. Dahlia, why don't you just keep an eye on how we're coming together and let me know when you think we want to get started. Looks like I've got a note from you, a couple more minutes.
I think we can start now, I think, actually.
Okay, well, I got one more sip of coffee here. And let's get started. So this is all about checking on where you are for the first half of the year and what to do on the second half of the year. It's an opportunity to stop at the first half and reassess, refine, and realign, and give yourself a chance to focus on what you want the business to achieve, what you want to achieve in the business. And we think that a midpoint is a great place to take a check on what's going on. I'm going to take a couple of minutes and tell you a little bit about who we are at Strategy Leaders. Strategy Leaders has been around for nearly 30 years. It came out of research that I did at Columbia University. We have put together here in the company a skilled team of employees who are all specialists at working on growth and development with owners of privately held businesses. And we also have a broad network of advisors that we work with and refer into clients based on the needs that they have. So if you're looking for a particular kind of expertise and you don't know where to go find it, certainly let us know that, and we'll be happy to see what we've got in our Rolodex to help you with. As a company, we have a tremendous amount of expertise working in all kinds of industries. And we work on a broad array of services. The core for what we do is training and development and teaching and coaching that helps entrepreneurs learn how to become business builders. It turns their ideas into solid documented plans that they can track to see how they're doing and generating growth, profit, and stability. We do work with all of our clients to teach them the skills they need to get to the next level. And we will, in many cases, work on project work that clients need in order to make progress. We do a lot of coaching of the business owners and their management teams. We have a big portfolio of family-owned businesses that we're working with, although I do like to say that virtually every privately held business is a family-owned business. Even if there's only one member in the business, it still gets talked about at the dinner table. And we think that family-owned businesses are incredibly important to the economy and the success of the U.S. economy, and that's why we do the work that we do. We do have a group of other services. We do valuations, where we help to establish an understanding of what a business is worth, either for exit or for acquisition. If you're interested in that topic, we have done a number of webinars on the topic and would be happy to get you clips from that or sign you up for the next one. Again, just put into the chat window that what you're looking for, and Dahlia will get you connected up. We do provide a lot of advice to business owners on how to buy or sell a business. We're not business brokers. We don't go out and find the candidates, but we do help get the deals over the finish line, which is actually the hardest part. Something like 90% of all deals never really make it to the finish line. And that's why we have the service we have, is to counteract that and to make sure that the deals that our clients are working on actually get done. We do a lot of planning of owner transitions. So what was one generation going to do as they move out? What's the next generation going to do as they move in? Whether those are employees, outsiders, family members, put together the plans to make that a smooth process. And then we do also offer dashboards, key performance indicators, and what if modeling and budgeting support. We're going to talk about some of that as we go through today's webinar. So with that, let's take a look at our table of contents. And in terms of what we're going to go over today, we've got a few sections. First, we're going to start out with understanding the basics, and I'm going to talk about some of the traps that I've seen businesses get caught in, give you some advice on how to avoid that. Then we're going to talk about a process for doing your mid-year checkup. We're going to talk then about what kind of adjustments you need to make and what you need to do in terms of going about setting goals for the remainder of the year. We've got a little bit of information on tools that you can use and tips that might be helpful. And then, as I said earlier, we'll take questions at the end. So with that, let's get going on understanding the basics. So the first three things that we talk about when we talk about a financial checklist and a financial checkup is three financial reports: the profit and loss statement, the balance sheet, and the cash flow statement. Three critical tools. I find that most business owners are most comfortable with the profit and loss statement, not very comfortable with the balance sheet. Often they're not even confident that it's right, and rarely use the cash flow statement. These are all tools that can be helpful to you. Get a good bookkeeper in place who can work with QuickBooks or whatever accounting system you're using, and learn how to get the most out of these three very important financial statements. Now, if we go on, we're going to take each one of these apart a little bit at a time. So if we go to the next slide, Dahlia, on the profit and loss, it's often also called the income statement. You want to have both an accrual version and a cash version. So what's the difference? Accrual is based on invoices and bills received, the dates that bills are received. Cash is when you pay the bills and when you deposit the checks or the payments coming in from your customers. We tend to use accrual if it's available, much more than cash, because it gets you closest to what's actually happening in the business. On an accrual basis, you have the opportunity to line up what you're invoicing clients and what you're actually paying to deliver on the work. And we'll get into that a little bit more. The income, don't go back, Dahlia, go back there. So the income statement is also a great source of key metrics. You can look at income sources, expenses incurred, overall profitability. But I do want to caution you that the income statement is not a true picture of net income, and it often gets misused by owners who proceed to make spending decisions that aren't appropriate, thinking that they're okay based on looking at the net income on the P&L, not taking into account what's happening on the balance sheet or what's coming in terms of future obligations. So here's an example of where you get off track. A company had 300,000 in net profit, but they had to pay off 350,000 in debts. All of that was coming off of the balance sheet. You could not see it on the P&L. And as a result, instead of having a huge net profit that they could use to leverage the company, they had to borrow $50,000 just to stay afloat to cover the debt payments. So they got paid off some of the debt and then went back into debt to continue to pay off the debt. Not a particularly successful scenario. Now let's look at the balance sheet. So the balance sheet has both short-term and long-term to it. Short-term classically is defined as anything that is less than a year, and long-term is anything over a year. There are three sections to the balance sheet. Assets are your resources. So that'd be cash and accounts receivable. Those are your short-term assets. So they're within 1 year. And then the longer-term assets typically are inventory, property, and other firm holdings. The liabilities side is the debts of the business. And on the short-term basis, you have accounts payable and the credit line. The credit line is always considered short-term because it is considered callable by the bank. And then you have longer-term loans and mortgages. As I said earlier, the principal payments are hard to see because they get mixed in on the balance sheet with new loans. So you'll see that the loan balance is dropping, and then all of a sudden it shoots back up because you took on a new loan for something, and it's hard to see how much is actually being paid monthly. But it is important to understand what the principal payment demand is and correlate that to what's going on to the P&L, which is something we do for all of our clients. Then the third section is owner's equity. The definition of owner's equity is assets minus liabilities. And I will say that we see that owner's equity often gets destroyed through tax planning. And here the example is that the company is trying to avoid taxes at the end of the year. They go ahead and make a bunch of purchases that they don't necessarily need to make, but they don't want to pay taxes. And as a result, they end up spending $3 to save $1 in taxes when they would have been better off just paying the $1 in taxes and putting $2 into savings. So I would encourage you, it's a kind of a messed up equation that starts with working with the accountant each year. And the most common question a business owner asks is, how can I save on taxes? The better question is, how can I make money so that I can put money in the bank, reward my people, and continue to grow the organization? All right. And then let's go look at the cash flow statement. The cash flow statement gives you a view of the money flow and the demands that are coming. It is really an essential tool for managing cash and debt structure. It incorporates invoices, accounts receivable, expenses, accounts payable, principal payments. So as you can see, it's pulling together data from both the P&L and the balance sheet. And then once it's in place, what you want to start doing is looking forward to be able to predict what's likely to happen. But in order to be useful, it does have to be used daily or weekly in order to have a real impact. So you have to be looking at it constantly. And here's an example of where a company might have difficulty that they couldn't see coming without a cash flow statement. So they had 2 good weeks, they had a lot of deposits coming in, but now they're about to have a bad week because there aren't any invoices left to collect. There's not a lot sitting in savings. And this week and next week, there are a whole lot of expenses that are due to be paid. Now, this is every business owner's worst nightmare. A lot of business owners have this figured out in their head, but you can transfer this to someone to manage in a cash flow statement if you get someone in place that has the knowledge to do that. All right, now there are some additional tools we want to talk about. We want to talk about a budget and a forecast. A forecast is based on sales estimates and history of performance. And this is where you develop a plan for revenue. We recommend that you have that plan broken out monthly and quarterly. So you're looking at what kind of revenue should I be getting every month for the next 6 months? And then the budget is the spending side of the equation. And you have 2 sections to it. One is cost of goods sold and gross profit. Cost of goods sold are the expenses that if you bring the revenue in, you're going to have to incur these expenses in order to deliver on the revenue that you collected. And cost of goods sold and gross profit should function as a constant % of revenue. Then the other section is overhead. So this would be the things that you have to turn on in order to come in and open up the office, the rent, the insurances, overhead staff, and so on. And this amount should be a fairly fixed dollar amount that you're spending with a small year-over-year increase. And controlling the growth of overhead is one of the key ways to growing profit over time as you grow revenue. So what you may want to do as you're looking at making progress with your budget and forecast is to lay out a game plan. So we're going to increase revenue by 15% year over year. We're going to grow our gross profit by 1 percentage point. We're going to grow our net income by 5 percentage points. And by even knowing those 3 simple numbers, you'll be able to back into what's going to have to happen with overhead and cost of goods sold in order to deliver on the plan that you're laying out. So you can work backwards into a plan, which is a nice thing to do. All right, now let's go look at key performance indicators. Another tool, then the whole modeling of the finances of the business. Key performance indicators, we consider them to be critical success factors. It can be a number, it can be a ratio, but the data does need to be accurate and timely. So for example, we've got a company that we just started working with, and when we laid their data out, we found out that because of some bookkeeping or accounting errors, the revenue that's being recorded is actually twice the amount of the revenue that the company is actually really earning. It looks really nice on paper, but it has no basis in reality. And if the company were making decisions based on thinking they had twice the revenue coming in, they'd be in real trouble when they actually went to collect the bills and the bills weren't there. So the data does need to be accurate. It also needs to be timely. Getting data 3 months later doesn't help you in terms of making corrections. You've got to have data that is up to date. You close your books within a week of the end of the month. You've got weekly data that you can get your hands on. That's how you want to run the KPIs. KPIs will link together goals and outcomes. So this is our goal is to hit this number, and then here's how we're doing week by week, month by month against that goal. So here's some examples of KPIs. You can look at weekly invoices. So how much do we expect to invoice on a weekly basis? How much work on hand do we have at any point in time? How is our revenue compared to break even? Is it above or below break even? What's the bank balance? What's our revenue per full-time equivalent? What's our average revenue per customer? What's our gross profit percent or our net income dollars or percents? And those are just a few of the myriad number of KPIs that you can track. This best bet is to find a dozen of these that you think are going to be very impactful, put them on a piece of paper, put them in a spreadsheet, and then start loading the actuals week by week so you can see the trending, if you're above or below where you want to be. Okay, then the next one is a financial dashboard. So this is something that a company has to go outside of itself to find. That there are lots of financial dashboards out there. I will tell you, we have a dashboard that our clients love because it gives them a huge view on what's happening in the business. And if you're trying to get a handle on what's going on, please come and talk to us about the dashboards and how that might help you. A dashboard is, in general, a graphical representation of what's going on. The theory being that it's easier to understand pictures than just look at numbers on a page. It does incorporate all of the standard reporting, the P&Ls, the balance sheets, and the KPIs. It looks for performance issues and successes. It helps you to spot trends, and it helps you to compare data. It needs to be rigorously tested. Usually when we start building a dashboard with a client, the first 90 days is what I call the shakedown cruise, as we're questioning, why is that graph that way? That's not my recollection as to what was going on. What's in there? How did that happen? And once you get to the point where the data is trustworthy and you have confidence in it, the best way to get there is by giving feedback to whoever maintains the financial reporting. But once you have a good dashboard in place, then not only can you keep a handle on how well you're performing at the moment, but you can also, if you've got a good dashboard, you can now start using it to forecast. And when you're looking at dashboards, what you're really looking for is movement and the comparison of relevant data. All right, next one. Next tool in your mid-year checkup to think about is evaluation. So evaluation assesses what the business is worth. It is classically starts out being based on tax returns. Why? Because that is the only document in this crazy opaque world of privately held business. That's the only thing that business owners sign, that they have to testify that it is right and risk going to jail or paying fines if it's not. You do want to have, in addition to just incorporating tax returns and mathematics that go with the tax returns, you also want to be able to compare the company to its peer group and figure out how the company is performing short and long term relative to that peer group. And you can use evaluation to describe the progress that the company is making at building value. So think about evaluation. If you think about a house and you own a house and periodically you get an assessment of what the house is worth, this is the same sort of thing for the business. And we consider valuations to be the ultimate progress measurement tool for owners and for their executive teams, because you can use them to develop bonus programs, to establish a sale value or a purchase value, depending on whether you're getting ready to sell or you're looking to acquire a business. And it also can be used to help the owner and managers with retirement planning, key person insurance, or the whole ball of wax on the benefit side. In terms of benefit bonus programs, I just want to come back to that for a second. There are a lot of times companies will start out with paying a percent of revenue. So if we grow revenue, I'll share a percentage with some of my employees. Well, that can be a pretty risky approach, because if the revenue isn't profitable enough, you could end up spending a lot of money for not a lot of value. Then business owners will shift to paying on gross profit. So that's better. But you have to make sure that you're bringing in the right kind of gross profit. So is this the kind of client that's going to be part of our future? Looking at the net income of the business is the next place business owners tend to go with their bonus programs. So let's share some of the profits of the business if we make a profit. And then, as I said, you've got to, when you're doing that, take into account obligations to pay taxes, to pay off debts on the balance sheet, to put money into savings programs, and so on. And all of that comes together in terms of the valuation, which is why I like using valuations to develop bonus programs. Now, one of the reasons that I don't think they're used as much as they could be is because historically valuations have been incredibly expensive. $10, $20, $30,000, $40,000 to get a valuation done, which I think is just absolutely nuts. They're not worth that much. And what we've been able to do is actually get our hands on a system that is very cost effective. For a few grand, you're going to get a very accurate and fast picture of what the business is worth, and you can continue to update that yearly without having to pay a bloody fortune. Okay, next slide. So when you're looking at evaluation, one of the things you want to think about is, what do you get rewarded for? And this is, again, where the rubber meets the road in terms of rewarding people for growing value. Valuation will grow if you've got consistent profit gains and steady revenue growth, if you're decreasing the reliance on the owner, if you have a diverse client base, so you're not just in a one-trick pony, if you've diluted your concentration, so no client is more than 8% of revenue, which is something the banks care about a lot as well. You want to make sure that you do properly account for owner compensation. This is something that I think a lot of owners miss the opportunity to boost the value of their business, because they don't think about how much the company is paying for their benefits, their car, their cell phone, extra trips and extra bonuses, and they don't add that up and then take that out of expenses and put it into profit. Deleveraging is really important. So getting the company debt free while you're operating it will boost the value. And then building reserves and equity is also going to boost the value of the business. So I like to say, if you do have debts to pay down, instead of trying to unwind the debts fast and get out of debt fast, you put $1 to debt and $1 to cash. And the reason for that is, once you get done paying off your debts, you also have a big cash pool to fall back on. If you just pay off the debts and don't put money into cash, once you get rid of the debts, the bank is probably not going to be all that interested in playing with you, because the bank's position is you don't have any assets, you just have a cash flow business. And if you have any questions about what that means and how that works, certainly just reach out to Dahlia and we'll schedule some time to talk. So here's an example of a business that has better value. It's worth more. It's smaller revenue with a broad customer base, higher gross and net profit, steady growth, and no debt. That is the fastest way to get to value. So don't worry that you're not growing revenue at 20 or 30% year over year. That may not be what you want to do. All right. Enough on that. Let's talk about how to go through a mid-year checkup process. So the first thing you have to do is you have to gather your documents. And in today's world, the stuff should all be online. It should be at someone's fingertips, whether you as the owner of the bookkeeper or you have a bookkeeper in place, somebody should be able to present all these documents in pretty short order. I will say that with the bank account, the vendors, the credit card statements, you do want to reconcile those statements so that you can verify the cash flow and verify the transactions, make sure they're properly recorded. When it comes to the invoices, bills, customer payments, bills paid, as I said earlier, you want to look at both cash version and accrual version. You're going to need both of those for reference sake. And then you're also going to want to go and pull financial statements from the previous year so you can compare. So if we're going to do a mid-year checkup, January to June this year, we're also going to want reports for the period January to June last year. And then we're going to want reports from July to December last year so we can see what happened in the second half of the year. And if you have a point of sale system that does not connect to your accounting system, definitely go there and pull data on what's happening with customer activity, what customer concentrations you have, who are your big customers, which products you're selling, and so on. All right. Then, once you've got all your documents, you're going to start to evaluate your performance. You want to compare year-to-date financial data with this year's plan and last year's actual. So if you started the year with a plan, that's great. Let's take a look at how we're doing. I would say that this year, last year, I saw companies that were at the mid-year check-in ahead of plan in general. They were doing well and building up steam. This year, I'm seeing more companies that are hitting some speed bumps. They're not quite on track with their mid-year plan, not quite where they expected to be. That's not everybody, but I'm seeing more of that this year than normal. You also want to compare to, or you want to look at your key performance indicators and highlight anything that is over or underperforming. So if it's right on track, that's great. Keep going. Go look at the overs and unders and dig into why is that happening. So is it an aberration or is it something that's been building over the last 6 months, for example? As you're going through all these documents, pull the documents out, take notes, make recommendations on adjustments you'd like to see, and then start to work on setting or revising goals for the rest of the year. So, for example, you might want to go and set a goal for Q3 and Q4 for revenue and dollars and gross profit percentages. You might want to use ratios in your KPIs to find hidden opportunity, like where are the best gross profits, where are the where are the lowest cost of goods sold percentages, and then go into overhead and look for any need to change. So usually by June of this year, you're starting to see overhead bleed a little bit further than it was expected to be in the budget. You're starting to spend a little bit more than was expected. This is a good time to dig into it and make cutbacks before it gets out of control in the second and third quarter, or third and fourth quarters of the year. All right. Now we're going to do some trend analysis. So you start to look at sales and marketing results. You want to segment your sales by product and by service. You want to look at what's declining, what's growing, and what's profitable, what the profit patterns have been. Evaluate the sales and marketing programs that you have in terms of ROI. So what am I spending and what am I getting out of that? Now, that has to be done on a macro basis because as we all know, there's no direct correlation between marketing and marketing efforts and revenue or invoice outcomes. The marketing tends to aggregate and build over time. So you've got to take your whole marketing budget and then compare that to your whole income budget. Now, you may want to look for any new programs that started. Do you see any correlation between we started a marketing program in March and we're starting to see an uptick in revenue from customers that would want those marketing programs by April or May? So you want to look for those correlations. Once you've done some of the analysis as to what's been going on, Then you're going to ask your sales team to work with you and your marketing team to forecast future sales trends so that you can make good informed business decisions about what's going to happen in the second half of the year. So think about how much lead generation activity are you going to need to have. If you think that you need to catch up, so you're a little bit behind, the time to put your foot down on the accelerator is right now. July, August, and September. Even if your customers don't start buying until September, October, start pushing on the gas pedal now. You want to look at the quality of what's going on in your CRM system, your customer relationship management system. So do you have an accurate picture of all of the prospects that you have? Can you report on what's going on? Can you look at what stage of development all of your work with prospects and suspects is at? Can you see the probabilities of how long it will take to close and the likelihood of closing and the dollar value of closing? And then and then turn that into forecasting. Again, if these are things you struggle with or you're not sure about, come and talk to us. Just put a note in the chat to Dahlia and ask her to set up time to chat. We'd be happy to help you figure out how to do that. And then you also want to look at how many proposals you wrote and how many proposals you closed in the first half of the year. Compare that to what you have to do in the back half of the year. Again, putting the emphasis on July, August, and September in order to realize value by the end of the year. And then August, September, October is when you want to push hard to start putting work into the first quarter of 2025. One of the things I tell most clients is as long as your gross margin is in line, then you want to look to do somewhere between 10 and 20% year-over-year growth annually. If you can do 10 to 20% year-over-year growth, you'll be able to stay ahead of inflation. It's not something that everybody out there does. In fact, the majority of the Fortune 500 don't pull that off consistently. But once you learn how to do that, and it's just steady forward progress year after year, the company is going to become a money generating machine. Now, in terms of managing expenses, you want to look for patterns in spending. So use the budget to optimize cost control. So we expected to spend this line by line. How much are we spending? Are we in line? Where do we have to make cuts? Where are we off? Spot the discrepancies and try and understand which expenses are growing and what you can do to reduce or manage them. Usually by mid-year, you've had a number of requests come in. We need a this, we need a that, we need to do this differently. You started to open up the purse strings. Now's the time to decide whether you keep those purse strings open or you've got to balance out and get rid of some expenditures in order to come in on plan at the back half of the year. As you're working on you're managing your expenses, you want to look at, is your cost of goods sold percentage stable? So what I mean by that is as revenue rises, your cost of goods sold expenditures rise with it. As revenue drops, the cost of goods sold should drop. Those two should be very closely tracking with each other, and that's measured in the percentage of cost of goods sold divided by revenue. That's what I mean when I say cost of goods sold percentage is stable. You also want to look for a cost of goods sold percentage that is at the most 30 to 50%. If you get a cost of goods sold that's 60% or higher, 70%, it gets harder and harder to make money. Now, I have a lot of clients that will come to us and say, yeah, but I'm in this industry. We're in the construction industry. We have tight margins. We're in a competitive position. We're bidding against lots of other people, and we really can't take the risk of pushing on our margin. It is fixable over time with strategy, with tactics, but you will be fighting tremendous headwinds as long as you have the business if you have a high cost of goods sold percentage. And I will tell you, if your cost of goods sold percentage is 80% or more, you need to fix that right away. It's almost impossible to make money. You have to be so large and have so much revenue going on that it's really hard for a small business to compete on that kind of margin. And the other things I talked about, what's above or below budget, what are the budget busters? All right, let's go look at cash flow. So when it comes to looking at cash flow, you want to look for patterns, ID issues that are coming up. Again, go back to the budget to find variances and look at what has happened in terms of managing liquidity and the plan for future needs. So the clients that I was talking about that are seeing a softer start to the year than they expected are also seeing a lower net income margin than they expected. They may have made some plans for spending on additional staffing or additional equipment, and you may have to rethink that if things are not recovering. So when you're looking at cash flow, you also want to think both short-term and long-term. Short-term, with weeks that have a shortfall, you want to think about where's the money going to come from. You've only got so many places to go. You can go to the previous week's cash flow if you have money left over. You can pull it out of the owner's pocket. You can go to reserve funds if the business has any. You can go into a line of credit, but that could be really problematic because now you may be just covering up problems and you may need a new loan, in which case don't wait until the last minute to go to the bank. Apply for those loans at a time when you don't need them because that's when you're most likely to get them. So you really want to make sure that you have a good understanding of what's going to happen to your cash week by week, month by month, from here through the end of the year. And what do you have to do to fix that outcome so that you have plenty of cash left over at the end of the year to put into your reserve funds to pay your taxes and to pay down the credit line. All right, then let's talk about strategies to improve your spending habits. I would say the first thing you want to do is get your management team involved. Don't try and do this alone. Don't try and get it all on your shoulders. You want to establish accountabilities for coming in on budget. So people get rewarded for managing to budget. If people are coming forward and saying, look, I've got a proposal for a new expense, ask them to make that proposal as an investment with an ROI, with a return on the investment. So if I give you the dollars to do what you're asking to do, how much money am I going to make off of it and by when? As a business owner, you have to learn to say no. This is often really hard for us as business owners. We don't want to disappoint anybody. We don't want to turn down someone who's really enthusiastic and charging ahead, but you may or may not be able to afford everything that everybody wants to do all at once. Make sure that somebody is negotiating regularly with your vendors. We've gone through a bunch of pricing increases, and right now we're seeing a lot of negotiating and concessions going on. Make sure that you do clean out unused subscriptions. So there are a lot of services that will charge you over time. You may or may not have actually exercised your right to cancel it if you're not using it anymore. This is something we actually recommend doing on a quarterly basis, is meeting with the management team to go through all of the subscriptions and saying, are we using it? Do we need it anymore? And encourage everyone to think about cost saving, to think about the money as the money that they have as a resource in order to keep that company safe and moving forward. Now, let's go talk about making adjustments and setting goals. When it comes to making adjustments, so you've looked at all of your tools, you've done some analysis, and now it's time to actually put a plan together for the back half of the year. You first need to be clear about what to fix and what order. And these are your usual drivers: revenue, margin, overhead, debt, cash reserves, and equity. So you have to decide which of these you want to tackle and in which order. I would say in general, I would tackle margin before I would tackle revenue. So what can I do to get my margin higher so that when I do push down on the gas pedal with revenue, I'm making more out of every dollar that I'm bringing in. Overhead, it depends on how tight you've been with overhead. What can I do to squeeze it down, to manage it, to control it? Paying off debt is an essential activity, especially if you are starting to near retirement age. You want to sell the business debt-free. And as I said earlier, make sure that as you pay down debt, you put $1 to cash reserves and $1 to debt. Because cash reserves are what will keep you safe. You know, we have a client right now. We started working with them on their cash program early this year, shifted the strategy from we're going to spend whatever we want to spend because whatever we spend, then we don't have to pay taxes on it, to we're going to build up profits, cash reserves, and have a strong position with the bank. And we have already helped them double the cash on hand. They've gone from $600,000 to $1.2 million in less than 6 months. And they are in a great position for the back half of the year where they tend to get a lot of revenue in. We've worked on margin, and the margin is what's contributing to the additional cash on hand. So you got to look at all of these tools as which order and how much. And if you're having trouble figuring that out, again, we'd love to talk to you about how to build a plan that will work for you and your company. Now, once you set the goals, you want, or as you're working to set your goals, you want to be clear about what you're expecting. So you want to do projections by product or by service, and as well as by customer. So you want to project revenue by month, cost of goods sold percentage, gross profit percentage. Look at which products or services are more profitable, which customers are more profitable. Who are you going to emphasize in the back half of the year? In terms of looking at sales, you want to also consider existing clients versus new clients. So how much do we need to weed out existing clients, or are our existing clients going to drift away and we have to have an aggressive new client program? We have to, that then turns into a discussion of how many leads do we have to generate, what has to come from marketing, what does sales have to do with those leads, how many proposals do we have to send out, what's our close ratio. Then you want to get into, which we talked about a lot, the cost reductions and timelines for cost reductions, which may give you some relief. Be sure to set overall measures for net operating income, net operating profit. I recommend setting both a dollar target and a percentage target. And then the next line item, this is something that most business owners don't take enough advantage of, is think about doing acquisitions to boost an outcome or to turn things around. So if you don't think you're going to hit your numbers by the end of the year, now would be a great time to look at doing an acquisition to fill a hole. And again, if you have questions about how to do that, we'd be happy to talk you through that. And then obviously make a consciously competent decision about when to talk to the bank, both to tell them what's going on so that they have confidence that you're in control, and also as you talk about what support you may need from them in the future. In terms of taking specific actions to adjust your course, I talked about getting managers involved before. You want to brainstorm with your managers. What's working, what's off. Update the financial forecast to reflect current economic conditions and market trends. So this is something where you want to ask your finance people to give you a projection. Go do some research, come back and tell you and the management team, here's what we see in terms of the economy overall and in terms of our industry. Here are the things that will be easy to deal with. Here are the headwinds. Then make sure that you reallocate resources to areas with the highest growth and profit potential. Ask the team to develop a list of ideas to consider, things that we could do. Split that list up and assign tasks so people to research, formulate ways to pursue it, and then set specific measurable milestones for my financial progress. And whatever you do, just don't carry it all on your shoulders. This is a team effort. The more people that you get involved in this, the better. I have a client that we have a dashboard for them. They're fairly significant size. They've brought 6 or 8 of their managers into the room to show them what's going on the dashboard. And what happened was the engagement of the whole team went through the roof as everybody started understanding. That's why we're talking about the margin. That's why we're talking about controlling overhead. That's why we're talking about the importance of this particular customer group. You got to make got to make it worthwhile for people to understand, or easy for people to understand. Now, I'm going to start wrapping up here. I'm going to talk about some tools and tips that you could consider using, and in terms of planning your next steps to enhance your financial management. I talked before about valuations. Look for an easy, inexpensive, fast to implement system that gets you a detailed explanation. We have one of those if you would like to talk to us about it. A dashboard will get you both historical information and a future forecast. The KPIs will help you to set up routines for reporting on performance, and they will give you data that you can look at to see what's happening over time. Then you've got to line up project work. So we need to get certain things done in certain order. And as you're working on project work, one of the things that you definitely want to think about is what you have to do to ensure finances are recorded properly. Do we need to do an audit? Do we need to do any reconciliations? Do we need to supplement the department because they're behind on their workload? Those kinds of things. When it comes to forecasting and goal setting, if you're not comfortable with it, get someone to teach you how to do it. It's not magic. It's not smoke and mirrors. There are actual methodologies that you can use that will allow you to reasonably accurately forecast and set goals. And then in terms of the overall business performance, make sure that you set up the structure so that you can stay up to date with what's going on. You don't have to be present. You can manage it on paper. You can be 1 arm's length, 2 arm's lengths away from what's going on and still be in touch with what's happening. And that's what I like to tell every business owner is if you learn to watch from a distance, you know what's working, you know what's not, you begin to get some freedom from having to have that millstone around your neck. All right. Then there are some additional financial management tips. Know your break even and how gross profit impacts break even. So what I mean there is if you have a gross profit of 30%, or a gross profit, or you can figure out how to change that to a gross profit of 50%, you're going to have to work less hard at that 50% gross profit, which means your break even is going to drop. You're going to make more money. You're going to drop more money to the bottom line. So you've got to know how much money do we have to make to break even and how do we get beyond that. Make sure that you do maintain a financial buffer, that's a reserve fund, have a plan to cover any unforeseen expenses. So not just what we're planning to spend, but other things that might come up. Figure out what you have to do to achieve stability. And again, this is what you're going to work on with your management team. Set short as well as long-term goals. Then monitor things weekly and monthly and be prepared to act quickly if things don't look right. And I also like to recommend join benchmark groups so that you can access valuable comparative data and perspectives and take advantage of networking opportunities that happen in a lot of these benchmark groups. If you're interested in that, we do have benchmark groups that we run and be happy to talk to you about that as well. And with that, I'm wrapping up and I'm going to turn this over to you guys. So we're going to take some Q&A. Ways that we can help, just coming back to where we started this, valuations, KPIs, forecasting, helping you with your business growth and the business plans that go with it, transition plans, management team development, benchmark groups, getting you advice on how to buy or sell or develop a next generation team. We'd love to talk to you. We're happy to have a free consultation, explore the possibilities. We talk to hundreds of companies a year. We consider that part of our community give back, and we'd love to have a conversation with you. And with that, Dahlia, do we have some questions? And I will be quiet and let you ask them.
Thank you. Awesome job, Andy. Yeah, we have a few questions.
Okay.
With the first one. My business is relatively new. At what point does getting a valuation make sense, and how often should I be reassessing it?
So you probably want to have at least 3 years up to 4 years of significant history. And by significant, I mean, you know, if the first year was just kind of getting started and very little revenue, I'd wait until you get to your 4th year and you've picked up some steam. You want to make sure that you're filing your tax returns on time because you are going to need the tax returns to do the valuation. And then depending on how you go about getting a valuation, we recommend setting it up so you're actually redoing it yearly. You can do it really inexpensively if you're working with someone that's got a system that just allows them to do the updates with the most current tax return. And it's going to give you a view of, am I making progress? Am I building the value of this asset that someday I'm going to sell?
Great, thank you. This one is about accounting software. Andy, do you have any recommendations about accounting software?
So it kind of depends on what industry you're in and the size of your business. The obvious standard is QuickBooks. They have been around a long time. They continue to develop the product. And they have, I think, a lot of tools for business owners that are quite valuable. There are other systems out there. NetSuite is one system that a lot of companies move up to when they find that they need more than QuickBooks. Then there are also, point of sale systems. And what I find with the point of sale systems, those are often developed by industry people. Many of them do have a back end accounting system that I don't necessarily recommend. You're better off taking the point of sale. So what's happening with the customers? How are we controlling our pricing and our invoicing? And then feeding that into QuickBooks, which you can automate it. I have yet to find a system that couldn't be automated to flow into QuickBooks. If you have questions, be happy to talk to you specifically about your business and what you're trying to accomplish.
Awesome. Okay, this question. The first half of the year hasn't gone as planned financially. What do you think are some immediate steps we should take to get back on track?
Okay, so and I would say this is a question I am seeing a lot of business owners this year starting to wrestle with after several years of growth coming out of COVID. So the first is try and find out where the problem is. Is it that we have existing customers who are falling away? We're not bringing on enough new customers. We've got old products that aren't as profitable as they used to be. So do we have a profitability problem? We're not diverse enough, so we can't move from one product or service to another. We can't pivot. Has our overhead spending gotten out of control? Are we doing too many bonuses in advance of actually making profits? So there's a lot of different layers to the equation. How much debt do we have to pay off? And are we actually making enough income to pay for taxes and debt and put money in reserves? There's a lot of questions that go into that very simple conversation. Be happy to help you try and figure it out and dig into it. And that would be where we would probably use our dashboard to best figure it out.
Great, thank you. And I think this is our last question. I think
Okay.
it's a good one to end on. What are some of the biggest financial mistakes that you see small business owners making?
The first one is tax planning instead of business planning. So overspending at the end of the year in order to save on taxes instead of putting money into savings. That's one. Number two is not having someone qualified to actually handle and manage the books. And by qualified, I mean they actually have accounting training, not that they've just learned to do QuickBooks from some on-the-job training. A third is that they don't look at the books often enough, or they don't have someone in charge of looking at the books. We have one client right now that has a negative bank balance of millions of dollars. Well, that's obviously something wrong with the books, because there's not a bank in the world that would allow you to run millions of dollars of a negative balance. So nobody's looking at the reports that are there available to be used to tell you what's going on. And I think the other thing that I think is that that they run hot and cold in terms of looking at the business rather than having routines for doing it. So the things get off track. We got to quickly look at it. We got to jump on what's going on and then back to work, as opposed to just steadily every month, every week, looking at a few KPIs. Are we on track? If we're not, let's do a little bit of adjustment, a little tweaking, and then let's just keep going from there.
All right, great answers, Andy. Thank you so much for sharing your knowledge, and thanks everybody for joining today.
Thank you guys all for being here. I hope it was helpful. Please let us know if this is useful to you or not, and reach out and we'd love to talk.
Great. Thanks, everyone. Bye.
Thank you.